Hello everyone, welcome to the channel. This is Fair Value Finder and today we are looking at AT&T Inc., ticker T. This company is my biggest regret. I bought back in 2019 for $34 a share. I started my position. I grew that position up to 100 shares and first time I learned about covered calls at this point. That was a year or two ago. And yeah, I think it was in 2020. I built my position up to 100 shares and started experimenting with covered calls. And then I ended up getting out shortly after the split of Warner Media last year for $17 a share. So my position got cut in half, and we'll look at why I got out, why I said I give this a do not buy runaway rating. If you own any, I'm not saying that you should sell, but I don't see the value in the stock at the moment. It could become a turnaround play if they're able to fix some stuff, especially having branched off the Warner Media, but that will stand to be seen. So we'll start with the chart as always. We're looking at the past 5 years at the moment. We see this downward trend ever since the end of 2019. We got one touch in 2021, and then it's touching again earlier this month. Trend line. Then we can go to the max, and we see that there's an even bigger trend line going on here that is being ridden now. It was a trend line above the stock price, and it has transformed to being below the stock price, being somewhat of a support. I mean, it's broken down below that twice as of late, so that trend line might just be dead. It likes to bounce around in this 2250 range. It just keeps hitting this. Not really a support or resistance, kind of a gap that it just flies through. I don't see a whole lot of support or resistance here. I guess we could say that looks like there's a lot of touch points down here at the 1750 level, which is where the stock sits today. So it could mean that if it doesn't break below 1750, it hits its support here, it could start bouncing back up. But they beat on earnings, and they're down almost 11%. So we'll look at why that is, and like I said, why I got out in the first place. So let's move on to the financials and take a look at those. Okay, here are the key financial numbers. If you've seen any of my other videos, which I suggest you watch if you own any stocks that I analyze, and comment down below anything that you want me to take a look at. I love to look at this stuff, so I will definitely make a video, post it. Hopefully it helps you learn something about what you're holding. First thing that you probably notice is this looks backwards. 2019 was the high in their revenue, been declining since. Everything, it looks the opposite of what it should be. And you'd be correct. We start with top line revenue. We see double-digit declines on a compounding rate. That is awful, atrocious. The cost of goods is declining at a faster rate than the revenue. So that is a green flag. That's something good. They stand a chance for a turnaround, but we'll see if that happens. They peaked back in high school in 1999 when they were in the low 40s. That was the best that they've ever hit. And they've kind of been on a downtrend since around 2000. Net income, triple-digit declines, awful. 2022, we see it went negative. That could be related to the Warner Media branch off. So we'll see what the 2023 numbers come out, but this is what they reported for last year. There's always underlying things that you can dig deeper into, but on a high level, still, even from 2019 to 2021, that was decent growth, but the huge turnaround from almost 20 down to -9 is massive. Their expenses have been dropping at a double-digit pace, not keeping up with the drop in the revenue. So it's a yellow flag. It's good, but not good enough. We want to see larger numbers there. EBIT, we see double-digit declines, as has been the case. 2022 is awful. There was decent growth from 2019 to 2021. We'll see what 2023 holds. The gross profit percentage is good. I like this in the 50s. It's been climbing, going from 53.5 to almost 58 in 2022. If they can hold that up there, they have an advantage over a lot of companies. As I said before, at least in the retail space, companies aim for around a 30% margin, 30 to 35. So a 57, almost 58 is incredible. Their net profit, as the case with 2022, negative. We saw decent growth from 2019 to 2021, and we see triple-digit declines because going from 7.7 to -7.2 is a pretty large decline. Earnings per share, that came in with $2.71 per share in 2022, which with a 20 PE ratio gives us a 54.2 share price. This year's earnings, analysts have projections of $2.44. We're going to look at the earnings after we look at these numbers. Quarter number one came in at 57 cents, as I usually do. The weighting of last year, that would put them on track to do $2.01. So a little bit below what analysts have projected. They must be factoring in Q4 more this year than they were last year, how things actually came through. Assets, very heavy on assets, but they're declining, down nearly double digits, compounding, down almost 27% last year alone. That is likely the branching off of Warner Media. So we have to look at the liabilities as well. We see a decline, not as steep as the assets. So they didn't pay down or offload as much liability as they lost in assets. Not a good trend that we want to see. There's not a lot of good here. Book value is negative across the board. That's the first red flag to me. If I see a negative book value, I will not touch the stock. Back in the day, I didn't care. I didn't look at this stuff, but I wish that I had looked at this, and I would realize that it is not something worth investing in. Free cash flow, we see it drop from 29.2 to 12.4, a almost 25% a year decline. Not good. I mean, the free cash flow value is still high. Just look at some of the other stocks that I've analyzed on this channel, but it's declining at such a heavy rate that it doesn't look like there's a whole lot of growth left in this. I mean, a turnaround is hopefully around the corner for them. I'll hop in once I see the signs, but they are not here now. We'll look at the earnings to see if they're doing better this year than they were in 2022. Of course, the negative book value means a negative share value. Just don't touch. Free cash flow. I mean, the free cash flow from last year puts the stock value on that front at about $32.50. And then the dividend down here of this last year puts it at approximately $32 as well. I think I had a target of the low 30s. on the stock. I no longer have that target. This not rated is what I would put the value at now, because I can't tell you. I mean, you're seeing a decline from earnings, expected decline, book value is staying negative. We're looking at a free cash flow, a massive decline, and the dividend, a massive decline. If they cut it again, even if they hold it, it would stay the same at the $31 level. But all of the value in the stock would be coming from the dividend at that point. Dividend and earnings, with the free cash flow weighing it down. Here are the earnings from last year. Q1, they came in with 77 cents. Their earnings today were 57 cents, 20 cents low. All of last year, they brought in $2.71, as we mentioned earlier. Based on the weightings from last year, I'm projecting that they'll come in with $2.01. They'll probably come in above that. They typically beat on earnings estimates, and analysts have them at $2.44. So it looks like they're putting a bit more weight towards the end of this year. Last year, Q1 was the heaviest quarter for earnings. And that might not be the case this year. As over time, we'll build up these pages and we'll be able to see how things typically go. And with all that being said, it's time for us to get into those earnings and see what's going on with the stock as of today. Here we go. We're going to look at three things today. They released like a news release, some slides, and the financial numbers. So we're going to start with these numbers. So they only give us Q1 of 2022 and 2023 to compare, and they did the comparisons for us. So we can see where their revenues are coming in at. They're going higher on service, lower on equipment. Total operating revenue up 1.4%. That's what we like to see. Revenues increasing. The cost of those revenues came in lower than last year, 0.2% lower. That's trending in the right direction. Their total operating income was up 8.4%. Their interest expenses, look at how heavy this interest expense is. I mean, it's almost a third of their operating income. They're just paying in interest. And that's up 5% from last year. So they got rid of all those liabilities, and yet they still are paying more in interest, likely due to the higher interest rates that we are seeing today. They could have had variable rates on their loans. Other income from continuing operations, down 12.5%. That is not what we want to see. Down 13%, including tax. Their net income down almost 14%. Red flag. Preferred stock dividends down 8.3%. But we don't own preferred stock. We just have common stock. Let's see. Basic earnings per share. We've already talked about that. Diluted earnings per share. This is specifically what we're looking at, down 12.3%. Assets. How are these trending? Assets are down. Not a massive amount, but they are down. Not what we want to see. Total liabilities, long-term debt. Here we go. That's down a bit. That's pretty good. Down more so than the assets. So that is trending in the right direction. So here we're looking at some of the expenses, capital expenditures, purchase of property and equipment, down 5.3%. The interest during construction, up 22.2%. So total capital expenditure down 5.1%. That's a good number. Acquisitions. So it looks like Spectrum acquisition down 99.3%. So they paid in heavy last year, and they're still paying on that, but significantly less. More interest. They're so heavy in debt. I mean, at least it's down 21%. Total acquisitions, expenses. Of course, it's down 96%. I mean, we do like to see that. That's probably why there was so much negative on last year, because it looks like they were acquiring. And that will wash out. Hopefully later this year, we'll see better numbers coming out from them. Interest. This debt ratio is awful. Common shares outstanding, down 0.1%. So recently they've been buying down shares again, apparently. I didn't see that in the numbers that I was looking at, so they must have bought them down this quarter. Total employees are down 8.6%. That's not a bad thing. They just need to do some restructuring. They got to pivot, and they need to turn around, because they're on such a decline that it's going to be hard. But telecom is a difficult business. They have a lot of competitors. Verizon's not doing great either. So it's not exactly a sector to be in. Like, there's a wide moat, but there's a lot of competition. Operating revenues, operating income up 4%. I think they go through a lot of this in the slides and in the news as well. But we're just doing a brief overview of all this. Monthly subscribers, looks like everything is going up. That's good news until you get to net additions. Okay, so it's going up, but not at the same rates that it was last year. Everything is negative. It looks like it's coming into a third, if not half, the rate that it was last year. Operating revenue down 5.5%. Operating expenses down 1%. Not good. It doesn't look like they're really doing what we need them to do in order to be willing to buy in. And that's why I said I don't even give them a hold rating. I give them a sell. I give a runaway. Operating income. What is this? Consumer wireline results. That is awful. Down 41% on operating income. The expenses were only up 5%. So the actual income was just down. Broadband connections. Operating revenue. Okay. Free cash flow. Here we go. This is a good one to look at. Free cash flow came in at significantly lower, almost half of what it was first quarter last year. And that's what we saw in the numbers. We saw it's declining by a quarter to one half year over year. So if at this pace, it's almost a third of what it came in at last year. And that's not even factoring the dividends. Free cash flow after dividends, they're running at a loss. And that's why I was saying they have to stop that dividend and work on this debt for them to survive. Income from consumer. Here's their EBITDA, up from last year. We do like to see that. It's not a massive amount, but it is up. The adjusted EBITDA is up slightly. Not at the rate that we would like to see. Oh, and it breaks it down by each segment. So we can see where the declines at. That's the real question. They have margins per segment. So we could dig really deep into this. I don't think you want me to do that here on the video, but we could look at what's growing and is it a high margin or a low margin portion of the business. Based on the other numbers I'm seeing, I'm assuming that it's the lower margin portions. Business wireless, EBITDA, 34%. Yeah, see, we were looking at numbers in the 50s on the financials. So that is coming from mobility, this mobile service. This one's one of their lower margin, up not too much. Operating income. Latin American segment is not doing too hot. That is a terrible margin. That's the type of thing you'd be looking for the net, not the EBITDA margin. TV. Okay, we're almost through all of this. I suggest if you hold or you are looking to hold AT&T, you come and you look through all of this. Net debt adjusted, because there's just some interesting things that you can find. Okay, so that's all for the financials. Now we can look at the news that they've released and see what are they saying about these numbers. You know, we drew our own conclusions, but what do they think about them? 424,000 postpaid phone net added, 11 straight quarters with more than 400,000 net adds, with continued low postpaid phone churn. Notice how they don't mention what the churn rate is. They just say it's low. 272,000 AT&T fiber net adds, 13 straight quarters of more than 200,000. High quality. Okay. We don't need to read through each of these. First quarter revenues, $30.1 billion. EPS of 57 cents compared to the 65 of the prior year. Adjusted EPS of 60 compared to 63. That adjusted brings it a whole lot closer. Cash from operation activities, $6.7 billion. Capital expenditures, 4.3, 6.4 in investment. A free cash flow of $1 billion. Last year, it was almost 3. So that might be why the stock is plummeting like it is, because people are saying that dividend is a huge risk to the company, and they might, they'll definitely benefit most just by getting rid of it. It's kind of a yield trap. I mean, the cut brought it more in line. It used to be hefty, 7 to 8% at times, but it's not worth it. Operating expenses. See, this is just summarizing everything we've already looked through. But this is what we would be looking for keywords in. So we look for growth. It's not letting me search. Growth, mentioned 10 times. Okay. Decline, mentioned 3 times. Offsetting declines, offset decline, offset decline. Okay. So they seem to be pretty happy with how things are going. And the other one to look at is inflation. Do they mention inflation at all? 1 time. These decreases were partly offset by higher amortization of deferred customer acquisition costs, higher bad debt expense, and increased depreciation. Additionally, business unit costs included year-over-year increases due to inflation. So they're just saying that the expenses are increased because inflation was bringing those prices up. Okay, I think that we are done with this. It kind of summarized what we'd already looked at, but nothing really jumped out. We looked for those keywords. They seem to be happy with how things are going. They talked a lot about growth, and when they did mention decline, it was a comparative decline. So now let's look at the slideshow that they put together and see what they were telling investors. I don't want to have to read through all of this, but they're trying to become more efficient. We'll see if the COGS go down and the revenue goes up. Hopefully that seems to be a focus to them. Oh, we got some nice charts here. Let's see. Postpaid phone subscribers in the millions. I see growth in almost all these charts, but they can cherry pick what they want to put on here. Fiber subscribers. Okay. So this consumer wireline EBITDA, mostly flat. Mobility EBITDA up a bit. See, a lot of their bottom line comes from this mobile service. It attributes way more to the bottom line than the wireline stuff does. The internet, the telephone. But the mobile phone, the cell phone, is where they're making a lot of their money. And we're seeing decent growth here. I mean, most of their growth is coming from their fiber service, which has a much lower carry through to them. But growth is growth. Okay. What is going on here? Earnings per share. Okay. Cash from operations, the free cash flow. I don't want to do the math here, but looks like it was a whole lot better last year than this year. And we know that last year was an awful year for them. Mobility results, wireline results. Okay. So nothing too spectacular in here. So bottom line, what do we think? I still think that it's a no-go. I mean, just the negative book value in and of itself is a no-go for me. But some things are trending in the right direction. That free cash flow needs to move back up. That dividend probably needs to be suspended. And they need to bring the expenses down, which they seem to be focusing on. I mean, they talk about becoming more efficient. So we'll see what that brings in the coming quarter. I know that the CFO said that they did a wonderful job this last quarter, and they're on track for where they want to be. Stuff can't happen overnight. It's a step-by-step process, and as long as that's what they're looking at, maybe in a few years it'll be worth it. But you could pick it up now. Just it's risky. It could double in value, go back up to the 34 that I bought in at, or it could just continue the decline that it's on, and that's the risk that you're taking. Can't really time the market. I'm not going to touch this one. I sold out. I'm going to stay out, and that's that. So thank you guys for watching this. Hopefully you learned something, maybe what to look for on stuff before you buy so that you don't get screwed over like I have in the past. And hopefully your stocks aren't down 11% today. So with that, I'll catch you guys next time. I will see what earnings are coming up. Try to do another one of these, especially if it's something that I hold or have held or is just popular. I'll look at what stocks are trending and try and get something prepared on those. Till next time. Bye.